Thank you very much. I think at a high level, markets seem reasonably priced. Spreads are okay, tighter than they were 12 months ago, but kind of around their 10-year average. Mix that with all-in yields that are more generous than we have seen for a while, and people feel okay about total return potential, break-evens and things like this. Markets technically well held, and at an index level it seems a quiet, low volatility story, and that's how it's played out for a while. But when you look a bit further and deeper into it, dispersion is high across the market. We like to see dispersion. We think it's a source of opportunity for us. It's being driven by a number of major trends that we think are going to be here and play out for a long time over this cycle. Some of the big ones include the divergence we're seeing between loans and bonds. Loans traditionally had been the sort of the safer part of the leverage finance market. Over time, they've allowed themselves to deteriorate in quality from a ratings perspective and from an outright quality perspective. They're going to face a tougher time going forward and probably underperform the bond market. Within both markets, we're seeing the impact of higher rates mechanically feed through into the challenges faced by individual companies, those who simply will find it tougher to pay their debts, pay their bills in this higher rate environment. We also see the higher rate environment as it persists for longer challenge some basic foundational thoughts about different industries, whether it's the property space, whether it's specialty financial space. That's a challenge we're going to see, and it's going to continue to play out in real time out there. And finally, Europe itself is going through a challenging time. We talk about the conflicting data. The US is hot with different signals. Europe is weak to kind of, worrying. Within that, we see the potential for a continued deindustrialization of Europe as it struggles with the energy challenge it faces. And within that space, there's a lot of cyclical credits that are performing very poorly, and if they don't turn around, they're going to have a tough time over the next 18, 24 months.
John, I was looking this morning at some of the SPACs, obviously heavily reliant on leveraged finance, and this was an area of the market that soared in recent years and then fell very rapidly from grace again. One of the big players, the so-called SPAC king, this is Palapataya, a few months ago was just questioning the whole role of leverage after effectively pledging some stock as collateral, and then the valuation of that stock fell aggressively amid the cost of capital story. What do you make of the options for some of the SPACs these days, given how the market is unfolding?
Well, I think that's a part of the market that was a function of the boom times we saw, and I don't see that coming back anytime soon. I think it's one of the consequences and fallouts of very aggressive policy. We see that play out in many different spaces, and I don't think that's coming back. I think there's a lot of kind of damage and wreckage that's going to be dealt with going forward.
John, I'm just dissecting a little bit and perhaps overanalyzing your first answer, so apologies if I have. You said that spreads are tighter than 12 months ago, but in line with the 10-year average. But that says to me that owners of this leverage risk are not being paid anywhere near what they should be paid. Tighter than 12 months ago. Well, we've seen multiple rate hikes up to the 550 basis points we've had over this whole tightening cycle. So tighter than a year ago, but we're tighter than we were, higher than we were on the underlying rates as well. And in line with the 10-year average. Well, I just had a good look at the last 10 years. And for most of that period, apart from a brief tightening cycle, 2016 to 2020, and again this recent cycle, interest rates were near zip. We're just not getting paid the right amount of money to own this stuff, are we, John?
No, I'm not going to put a huge debate or challenge to the statement that spreads aren't enormously attractive. It's fair to say that one can question do they compensate you for potential recessionary risks. But I think the balance that they provide in terms of total return potential, with the all-in yields being much higher than they used to be, means that the potential to make decent returns over time is reasonable enough with the low duration backdrop. I think that break-evens, given the index is around 7.5% with a 3-year duration, you need to go 300 basis points wider to lose money on a 12-month look forward. I think it's fair to say that fundamental value can look better in other parts of fixed income, parts of corporate investment grade, the higher rated parts of structured products. But with the market being technically solid, the leveraged finance market's actually shrinking. It shrank by about 18% over the last 15 months. It's shrank in duration also. You can see that people sort of feel solid about it, and it's performing reasonably well.
Yeah, fair point.